You want to invest, but every time you're about to pull the trigger, something stops you. Recession warnings, inflation fears, unsustainable debt, war tensions, the AI bubble about to burst, stretched valuations. And these aren't fringe theories. These are credible analysts saying scary things. So you wait for clarity. But here's the problem. Your brain just hears danger many times and freezes. And while you're waiting, the market keeps moving. Here's what nobody tells you. That hesitation isn't caution. It's handing control to people who have never beaten the market by predicting it. One of the most successful investors in history has been saying this for 50 years. Warren Buffett has made this point so many times. He doesn't pay attention to what economists say. Not casually. Not strategically. Not at all. In over 50 years of running Berkshire Hathaway, one of the most successful investment companies ever built, Buffett and Charlie Munger never made a single major decision based on a macroeconomic forecast. Not one. Not because they didn't have access to forecasts. They had access to the best economists in the world. They just didn't find them useful. And Buffett's reasoning is straightforward. If listening to economic forecasts led to better investment results, you'd see a lot of economists who got rich from trading. But you don't. Despite being highly intelligent, despite having all the data, most economists don't produce super wealthy investors. Because predicting the economy and picking good investments are not the same skill. Buffett's pointed about this in a way that's almost funny. He's been quoted saying that anyone who has an economist has one employee too many. That's not a joke. That's his actual position. So why doesn't it work? 3 reasons. First, economic forecasts are often just wrong. Not because economists aren't smart, but because the economy is staggeringly complex. Too many variables, too many feedback loops, too many things that can shift between the forecast and the event. In hard sciences, you can predict an eclipse centuries in advance because the system is closed and the rules don't change. The economy isn't like that. It's made up of billions of decisions by billions of people reacting to each other in real time. You can't model that with the precision needed to make reliable investment calls. Second, even when forecasts are directionally right, the timing is almost always off. An economist might correctly predict that a recession is coming, but if it happens 2 years later than expected and the market rises 30% in the meantime, that forecast cost you money even though it was technically accurate. Timing is everything in investing, and forecasts are terrible at timing. Third, and this is the part that matters most, stock prices don't move in lockstep with the economy. Some of the best years for stocks have happened during or right after recessions. Some of the worst drops have happened when the economy looked strong. The economy and the stock market are related, but they're not the same thing. And focusing on one to predict the other is like trying to navigate by looking at the wrong map. So, if Buffett isn't listening to forecasts, what is he doing? He's focusing on individual companies, not the economy, not interest rates, not GDP growth. Companies, businesses that produce real products, generate real revenue, and have competitive advantages that are likely to hold up regardless of what's happening in the broader economy. Buffett's approach is bottom-up, not top-down. He's asking, is this a good business? Is it well managed? Is it priced reasonably? Will it still be valuable in 10 years? And none of those questions require an economic forecast to answer. There's a story Buffett tells about John Maynard Keynes, one of the most influential economists who ever lived. Keynes tried speculating based on economic forecasts early in his career. He failed. He lost money. Later, he switched to a value investing approach, buying undervalued companies and holding them long-term. And that's when he thrived. The lesson isn't that economics is useless. The lesson is that even one of history's greatest economists couldn't use economic forecasting to beat the market. But a patient, company-focused approach worked. If Keynes couldn't do it, the odds that the average investor can are pretty slim. So the question becomes, if forecasting doesn't work, what does? Let's get practical. If you're not supposed to listen to forecasts, what's the alternative? How do you invest in a world where things genuinely feel uncertain? The honest answer is this. If you have the time, skill, and interest to analyze individual companies the way Buffett does, you should do that. Read annual reports, understand competitive advantages, evaluate management, figure out what a business is actually worth and whether the current price makes sense. But here's the reality most people don't say out loud. Most investors, even disciplined, intelligent ones, don't have the time or expertise to properly value individual companies. And trying to do it badly is often worse than not doing it at all. You end up with a portfolio full of stocks you don't actually understand, held for reasons that evaporate the moment the price drops. So if you're not going to analyze companies like Buffett does, and most people won't, the next best thing is to own all of them through an index fund and focus your energy on the part of investing you can actually control. Not which companies to pick, but how much to invest, when to invest it, and whether you can stay disciplined when everyone else is panicking. That's the version of ignore macro, focus on companies that's actually accessible to most people. You're not picking the companies, you're buying the whole market. But you're still making decisions based on observable conditions, price, valuation, sentiment, not trying to predict what the economy will do next year. And here's where most people can actually improve their results without needing an MBA or 60 hours a week to read financial statements. Let's say you have $1,000 to invest every month. Instead of putting all of it in immediately, you might invest $700 on your normal schedule and keep $300 in reserve. That reserve builds up, and you deploy it when one of a few simple conditions is met. Condition 1, the index falls below its 200-day moving average. That's just the average price over the last 200 days. When it crosses below that line, it means the price has dropped significantly from recent highs. You're buying at a discount to the long-term trend. Condition 2, RSI drops below 30. RSI is a momentum indicator that runs from 0 to 100. Below 30 means oversold. The price has dropped hard and sentiment is extremely negative. Historically, those have been good buying opportunities for patient investors. Condition 3, widespread panic. This is where Buffett's most famous line actually applies. Be greedy when others are fearful. Sometimes you don't need a technical indicator. The signal is just obvious. March 2020. Markets down 30% in weeks, everyone predicting worse. If you had dry powder then and deployed it, you caught one of the fastest recoveries in market history. Not reckless, not gambling, just willing to act when everyone else is frozen. The key principle is simple. You're not abandoning dollar cost averaging. You're layering in opportunistic buying on top of it. Your base investment happens no matter what. But when conditions are clearly favorable, prices down, fear high, indicators flashing oversold, you have extra ammunition ready. And you're making these decisions based on observable conditions, not forecasts. You're responding to what already happened, not predicting what comes next. Now, important disclaimer. This is one approach. Some people are better off investing the same amount every month for 30 years. No tracking, no indicators, just consistent automatic execution. If that's easier for you to follow, do that. Because the most important thing is picking something simple enough that you'll actually stick with it when the sky feels like it's falling. The worst investing mistake isn't using the wrong strategy. It's abandoning your strategy at the worst possible time because it felt too complicated to maintain. Here's the uncomfortable truth about economic forecasts. They feel like information. They feel like you're being responsible by paying attention. But for most investors, they're a distraction at best and a costly mistake at worst. Because while you're waiting for the forecast to get clearer, the market keeps moving. And by the time things feel safe enough to act, prices are usually higher than they were when you were paralyzed by doubt. The investors who build real wealth through uncertain times aren't the ones who predicted what would happen next. They're the ones who stopped trying to predict and started focusing on what they could actually control. What companies do I understand? What prices make sense? Do I have a plan I can stick to even when it feels uncomfortable? Buffett's been saying this for 50 years, and the results speak for themselves. You don't need to know what the economy will do next year. You just need to know what you're buying, why you're buying it, and whether you're getting it at a reasonable price. Everything else is noise. And the sooner you stop letting that noise dictate your decisions, the sooner you start investing like someone built to survive whatever comes next. So here's the question worth asking yourself. If the smartest investor of our generation has spent 50 years ignoring economic forecasts and still built one of the most successful track records in history, what would change about your investing approach if you stopped waiting for the forecasts to agree? If this video helped you, consider subscribing. You can also like, comment, or share. See you in the next video.